For years, professional money managers and hedge funds have tisk-tissed about individual investors. They have been dismissed as just dumb money and cautioned that so-called retail investors lack the acumen and experience to make the right calls and weather the inevitable storms. That has often been the case, but then came the GameStop phenomenon, when a tsunami of that so-called dumb money flooded part of the stock market, leaving Wall Street professionals not just scratching their heads, but a few of them badly wounded. And while this might not be an anomaly, it more likely is the first rumbling of what will prove to be a radical transformation of money and markets. If you haven't subscribed already, please take a moment to hit the bell icon and subscribe. Thank you. In less than a week, shares of the company GameStop rose more than 17-fold by the end of trading on January 27th, after its prospects were touted 2 weeks ago on a Reddit subgroup called r/Wall Street Bets that has several million subscribers. GameStop, a retail chain that started as a hub for video games and has struggled mightily in an era of COVID-19 and streaming, was a much reviled stock until a few years ago, and in this case a few days ago, and was heavily bet against by Wall Street pros who stood to make money as the stock went down. When funds bet against a company, however, they become vulnerable when the stock goes up rapidly, forcing to cover their shorts, which is buying back the stock that they had sold on credit, assuming it would go down, which in a worst case scenario can lead to results in losses just as substantial as those faced by someone owning stocks when markets plunge as they did in March 2020 or in the late 2008 into 2009. This time, however, it wasn't the professional managers who profited while retail investors suffered. For sure, some have pros and have jumped in and off, and momentum bandwagons with good results. On Thursday alone, the stock was up 20% and then down as much as 40% by day's end. Most striking is how these amateur investors flocked to a widely read social media message board, orchestrating a massive takedown of several marquee hedge funds while profiting hugely in a matter of hours. This could only be compared to a SEAL Team 6 level of coordination among a bunch of amateurs. Not only are Wall Street players aghast when one pro is saying that the moves were unnatural, insane, and dangerous, but the surge in GameStop from less than $2 billion in market cap to more than $24 billion in a such short time got the attention of the government, of regulators. The Attorney General of Massachusetts, William Galvin, said he was looking into the matter and called for a halt in all GameStop trading, and the White House press secretary said the administration was concerned about market integrity. The blowback against this was swift. On Reddit, one participant summed it up: market manipulation by federal pumping dollars into failing banks and corporations is okay, but Reddit users rallying GameStop is wrong and must be regulated. Funny how quickly the financial press cries for hedge funds. But that is not the end of the story. But all the fuss raises a question for the times when water settles and calms down a notch. Can it compete with market giants? Can Reddit compete with hedge funds? I'm not talking about stock market giants, rather the industry giants like Steam and Amazon that have dominated both the retail sales of games and retail equipment, as well as others. It's not that you cannot trust these platforms, and I'm sure a majority of you are loyal customers that return to their websites often to get your hands on games, consoles, and equipment and other peripherals. It's just saying that you should consider it. Many investors fully understand the contradiction between the GameStop stock price and its business fundamentals. But for those who imagine it to be the next Tesla or Amazon, the truth is, it's likely not. The company's quarterly report issued in September showed another sleepy quarter sales decline as it struggles to adapt to the rise of mobile gaming and digital downloads that have rendered its more than 5,000 stores obsolete, even more so during a pandemic. And the attention-grabbing media coverage didn't bring shoppers back to the stores in recent weeks either. Customer traffic declines accelerated in January. Cohen's investment firm RC Ventures owns 13% of GameStop. That stake makes it the second largest single shareholder of GameStop. Those shares cost tens of millions of dollars, and they put Cohen in a position to more directly engage with the company's leadership. In September 2020, when Cohen initially purchased a significant chunk of the company's shares, he privately proposed a plan to the board to focus GameStop on e-commerce opportunities. One example of these opportunities is tied to GameStop's core business, reselling used games. Cohen reportedly proposed an online version of the retailer's infamous game trade-in program. During these talks, he proposed a major expansion of GameStop's online footprint. According to Bloomberg, beyond just games, GameStop's online store would offer a wide range of merchandise, the report said, and prioritize fast shipping. Cohen has yet to publicly spell out his specific plans, and his representative didn't respond to a request for comment as of publishing. Ultimately, a company that trades on the stock market is worth whatever investors decide it is worth. There is no fundamental value to which everything must return. That's in part because the future is uncertain. If enough investors believe GameStop could develop a loyal customer online base, becoming the Chewy of video games, nothing might dissuade them from that view. In fact, they could help the company along by allowing it to raise capital. But the number crunchers said it was very difficult to see a future that justified the current stock price. Mr. Stevenson, the professor, offered a best-case scenario. GameStop manages to take in $4 billion in sales this fiscal year. He noted that stock in Best Buy, which is a profitable company, trades at 0.65 times its sales. Applying that ratio to GameStop produces a stock value of merely $40, which is far higher than the levels it traded at just a few weeks ago, but it is still much lower than the current share price. If the stock stays far above last year's levels, Wall Street analysts might well find reasons to raise their targets for the stock price, even if the company's business does not materially improve whatsoever. GameStop may be an extreme example of market exuberance, but it is hardly alone in defying expectations. Since it fell sharply last spring when the pandemic took hold, the S&P 500 index has surged to new highs, even as economic input remains subdued and will likely stay that way for at least a few more months. Look at Tesla, for example. Their stock price has gone up by at least 10 times. It's ridiculous. It is also critical to understand the market position of GameStop as a business, and if they even have a customer base that may help them sustain the business long enough, it manages to capture the decent market share. A small surge based on a frenzy of Reddit is not enough to predict the exact future of a company that is way far behind the e-commerce scene. Platforms like Epic Games, Steam, Amazon especially, are all way ahead, and they have deep roots in the ground already. Now, either you can adopt the new normal or go out of business, since miracles like these happen twice in a lifetime. But do they even stand a chance to get market share? Share your thoughts in the comments below. If you enjoyed this video, there are more on this channel, so don't forget to check it out. Also, do subscribe to the channel and hit the bell icon to get updated on upcoming videos. On that note, I would let you click on the next video, and thank you for watching.